Hello and welcome back to Market Shares. I'm your host, Tony Blodgett, and today I'm going to just do one of these episodes where I'm going to roll through some of the top headlines in the mortgage and real estate world. I'm going to give you kind of my thoughts and commentary on them and bring you up to speed on what's going on around the mortgage market here recently. So let's just jump right into it. You know, today CPI was released on the day that I'm recording this, and this headline says inflation is rising, but mortgage spreads have kept rates under 7%. Well, thank God, right? We've talked about this where mortgage spreads, the spread between mortgage-backed securities and 10-year treasuries has definitely tightened. And, you know, as I mentioned a few weeks ago, had we seen the same kind of pressures on rates with this war in Iran a year ago, we definitely would have been over 7% already. But luckily, we're sitting here in the mid sixes despite the pressure. Now, I will tell you that what I'm seeing is pretty significant pricing compression in the market as things. I wouldn't say they've slowed. I mean, what I see is really good closing months, but it should be, because this is the time of year where we should be having our busiest months. So we are off of the numbers that we saw, the number of applications towards the end of February when rates were getting there under 6%. It's definitely slowed down. But what we saw today was CPI rose 0.6%. And that's putting inflation at 3.8% year over year. That's the headline number. The core CPI came in a bit lower. I think it was around 2.8% or 2.6. Nonetheless, not a great number, not what we want to see, but also not surprising. But the good news is rates are kind of holding steady with those spreads helping us out. And, we would probably see rates definitely up in the, 7.1 to 7.5 range if those spreads were still in place. So that is the first headline: is inflation is rising. This is no surprise. Now, here's an article that talks about mortgage rates moving higher, keeping the spring housing market in a holding pattern. Of course, that's what I just talked about. I mean, it's good, but it's not like I think it could have been had we not had this disruption in mortgage interest rates. Couple other things that I want to touch on here is Figure. So Figure posts strong Q1 surge in blockchain lending activity. To me, this is a little bit about Figure and the fact that they're a blockchain HELOC lender, but it also points to that people are leveraging home equity lines of credit in order to tap into their equity. We know that people need to tap into their equity right now. There's no question about that, but we see a lot of people leveraging home equity lines of credit in order to do that in a second lien position with interest rates kind of creeping up a little bit. So look, if you have access to doing home equity loans, this might be an untapped area that I think a lot of loan officers typically won't venture into. The loan amounts are smaller. There's probably not as much compensation in them. But keep in mind, doing a second mortgage for your clients, in my opinion, is really an act of customer service. It's helping them with it's solving a problem they have today, and it's setting up an opportunity to help them consolidate those loans together in the future when interest rates do get into a more favorable time. So to me, a headline like that is just a reminder about, maybe don't just refer off those second mortgages. Maybe use that to deepen your relationship with your borrowers. Couple other things here. I want to go to the next page. One of the headlines is in regards to the larger mortgage lenders are seeing profitability, and but there are cracks in the there are some cracks in the market. So let me get to this headline really quick. And what we're seeing here is that for many of our larger mortgage banks, especially those that have servicing and a wholesale presence, we are seeing a little bit of profitability. And look, that hasn't necessarily been the case over the last few years. And for many of them, it's that servicing portfolio that helps them continue to show profitability. But what this is telling me is that we're seeing a focus on efficiency. And I'm going to talk about that. There's another article that mentions efficiency. I'm going to talk about that. But what most mortgage lenders are focused on right now is driving down their cost to produce. And those that are doing a successful job at accomplishing that task are seeing profits. The market has been pretty good. Like I said, not great, but if you can couple that with better efficiency and cutting out unnecessary expenses, then that can put you in a pretty good position. And we're seeing that with many of our mortgage companies. There is an article here about LoanDepot in particular. LoanDepot was not listed on the list of profitable companies. Matter of fact, I think, if I remember correctly, they had a loss in Q1 of about $54.9 million, following a previous loss in Q3 of about $32.8 million. This article is regarding LoanDepot is seeking flexibility to raise capital through $250 million of shelf filing. That's leveraging some of their stock in order to borrow money, which it looks like, based on this article, is really just for general corporate purposes. To service debt, to invest, working capital, acquisitions, and just normal capital expenditures. So I don't know if that's a great formula. I mean, LoanDepot with their CEO coming back and really making a push right now, but continuing to show. Well, one of the larger companies, I think they represent the 5th largest mortgage company in the industry, struggling to show profits in the last 2 quarters at least, and I think it's been more than that. So, not everybody having the same success in the market right now. You guys might have seen UWM and CrossCountry both making a bid to purchase out mortgage servicer Two Harbors. And this has been kind of a back and forth thing. Now the price is up to $12.50 a share. UWM raised its unsolicited bid for Two Harbors up to $12.50, pushing out CrossCountry's previous bid at $12, all cash deal that they had, ahead of the May 19th stockholder vote. So Two Harbors is going to be purchased. The question is it UWM or is it going to be CCM? And look, to me, this is just telling you how important servicing is to mortgage companies. Everybody wants to either be retaining the servicing on their loans. We see a lot of acquisitions that have happened over the last year and a half, all around acquiring MSRs and servicing rights. And this is just another play. And it'll be interesting to see how that one shakes out. And really, what is the competitive advantage for those companies, especially if you have to expend that amount of your capital in order to acquire the servicing? I would have to think that they would have some pretty good plans for that. Here's another interesting one, CDFI. I talked a lot about CDFI about a year and a half ago, and CDFI is Community Development Financial Institutions. There's only a handful of CDFI companies that can offer CDFI financing in the country, and these funds are set aside by Treasury, on what can be lent through these CDFI approved banks and credit unions. And they just cut the funding for CDFI from $324 million down to $119 million, stating that there was a lot of fraud and just kind of misrepresentation, misuse of those dollars. Now, what's interesting about CDFI is it's the only program out there that can really be outside of the ATR rules, the ability to repay. So you can see in some instances with good credit scores, like full no-doc loans available through these CDFI banks. So, and look, I think there's some cases where this type of financing can be very helpful in, local community development. And but it, obviously, just based on the type of loans that they are, it's not surprising that there might be kind of a misuse of some of those funds. This article in particular is really criticizing that, cutting down the availability of the funds itself and the exposure to this type of financing isn't really solving the problem. The problem is if there's fraud and abuse going on, we need to put guardrails in place, and we need to address that waste, fraud, and abuse, not just simply cut the funding and have less funds available, but not do anything about the waste, fraud, and abuse, right? But that's interesting. So if you're someone who's doing CDFI loans, then you might want to be aware of this. This represents a 63% reduction in the funding that will be available in 2027 for these types of transactions. So that's interesting. And on the heels of that, I would say that falls into the non-QM category. The true non-QM loans, which do have ATR rules, we see expanding, pretty drastically right now in their usage and utilization. So it's kind of interesting to see kind of a segment of that is kind of losing some of its capital. It'll be interesting how that impacts the banks who focus on CDFI. One of the articles is talking about what does efficiency really mean to mortgage lenders today. And this article, it says, what lenders are really saying about efficiency in 2026. And I'll tell you the gist of this article is that efficiency is no longer a nice to have. It is an absolute necessity. I talked about this in just a previous episode about, leveraging AI to drive down your cost to originate, and, a lot of these kind of nice to have things. But the reality is with margins continuing to compress, volume, not being where anybody wants it to be, the number one thing that you can do to make sure that you're a profitable organization is you can work on improving your efficiency. So this whole article is about, it's no longer a nice to have. It's absolutely a must implement. And I personally believe that AI, the companies that can really lean into AI to help facilitate that, are really positioning themselves for where they need to be in the next handful of years. Meridian Link expands AI offerings as volumes. Here's another article about AI. There's quite a few of them. Another article here that touches on April's CPI number. Inventory growth making housing more affordable. I'm going to do a deeper dive on my next episode about this. We're going to talk about inventory growth because there's a lot to unpack here. And to be honest with you guys, there's definitely been inventory growth since 2022, but it fluctuates a lot month to month, and it's actually might be turning a little bit negative, but yet there's still some positives, and there's a lot to go through on that article. So I'm going to dedicate a short episode to diving into that one in particular. This was interesting. Equity-rich homes share falls to lowest level since 2021. So if you remember, we've shown some charts in the past that show the percentage of homes that have, significant amount of equity versus those that might be, drastically underwater. And so equity-rich homes, those at the highest level of equity, the share of overall homes that are considered equity rich is at the lowest level it's been since 2021. This tells me a couple things. One, in some parts of the country, it's a factor of home values leveling off or even declining in certain markets. It's also representative, in my opinion, of people tapping into the equity that's in their homes, right, for other things, maybe for other investments, maybe to help consolidate debt. So people are accessing their equity, and that is changing the dynamic of the number of homes that have significant equity in them because people have leveraged that equity for other things. It also is representative to me of, the home buyers that have moved into home ownership in the last couple of years that obviously have not had all that appreciation creating those large equity positions. These are more people that are purchasing purchasing their first time home or, putting a reasonable down payment into a home. So that has started to skew the numbers. So it is shifting a little bit, and you're seeing less of those equity rich homes in the market. It's not significant, but it is a shift, and it tells us things are moving, is what it tells me. Let's see here. Existing home sales rise 0.2% in April as inventory grows. So again, this is why I'm going to talk about inventory, because we have some articles saying that inventory is almost negative year over year growth, but there's a lot of talk about inventory growth. Here's what I'll say is that, at the end of the day, existing home sales at 0.2%, that is not a super strong number. And it is helping to, you couple that with the inventory that we're going to talk about in our next episode, and it is helping out affordability. That's going to be really the whole main point of my talk. A couple other ones I want to jump on here for you guys. So this one's kind of funny. After Spirit Airlines collapsed, a broker offers laid off workers a new takeoff in real estate. It's been funny watching all the memes around the industry about Spirit Airlines. This one's about offering jobs, but all the crowdfunding, memes out there and people talking about, buying up Spirit Airlines. It's just kind of interesting. That's kind of a fun one. Mortgage credit availability has tightened in April, the MBA says. I did read through this article. I think this is interesting. It's not a big shift, but it is noticeable, and that's not what we want to see, right? We want to see more credit availability. So for things to tighten up a little bit, I think is interesting. And if I click on this article here, what it was pointing to is down 0.4% to 107.9 according to MBA. ICE Technology. Conventional credit tightened by 0.6, driven by pullbacks in jumbo and super jumbo programs. So that's right. So this was really around just availability of jumbo paper. So while government credit was unchanged and conforming availability actually inched a little bit higher. So we're okay on the conforming conventional. It's that high end, that jumbo market appears to be tightening down just a little bit. And let's see if there's one more that I can grab for you guys before we wrap this up. Trump to Congress. Pass the ROAD Act with institutional investor ban. So you guys, this is Trump really pushing them to ban the ability for institutional investors to be purchasing up single family homes. This has been kind of in and out of the news a little bit. So this legislation looks like it is currently in limbo. The U.S. House passed its version, but the Senate bill is hanging out there. So look, I could not agree with this more. This would ban institutional investors who own 350 or more single-family homes from purchasing additional single-family homes. So it doesn't force anyone to sell what they have, but this would definitely, I think, curb the interest in getting into purchasing single-family homes for any sort of the hedge funds or large groups out there, because you'd be limited to 350 or more. And if you're already in this business, it kind of puts a pause on it, which I think is a good thing. We do not want our inventory sopped up by institutional investors. Not only is it bad and drives up the affordability issues, drives up the prices of homes, it also doesn't do anything great for building great communities of homeowners. You want to live in a community. Part of the reason you buy a home is to be part of a community. And when you have these huge developments and the renters are kind of peppered all throughout that, and what you're looking for when you're buying a single family home is that sense of community. And now you have tenants that are moving in and out. It does change how some of these neighborhoods can feel. I'm not saying we don't need good, rental opportunities for people. We absolutely do. But when you bring in, institutional investors and the strategies in which they deploy to buy up whole segments of, plats and things like that, it can really change the dynamic and impact everyone's value in that area. So I think for so many reasons, this is a good idea. We'll be interested to see if this gets passed. So you guys, that's a little walk around the interwebs here. Nothing, look, it's kind of I don't want to say slow news, but it's there's nothing earth shattering that I'm reading. It's kind of right now we're waiting to see what's going to happen with this war in Iran. And as of the time that I'm recording this, I think literally this morning that President Trump said the last negotiation from Iran, I think he basically said it was garbage and he didn't even finish reading the whole thing. So at least as of the day I'm recording this, which is on the 12th of May, it's not looking good. It's not looking good. The MBS market is, kind of in a little bit of a tailspin today, partly because of the inflation numbers. I'm sure partly because of the deterioration of the ceasefire and the talks in Iran. So, I think that's something everybody's watching very closely. I do feel like the numbers are staying okay through all of this. We're seeing an okay, housing market, but that's propped up by the season that we're in. We should be gangbusters right now, and instead we are doing okay. I would like to be back to gangbusters. And I think that once we get this war and everything behind us, we see some stability in oil prices. And we get our new, Treasury Secretary in there, not Treasury Secretary, I'm sorry, the Fed Chairman in there. I think we have a lot to look forward to, but it's going to be kind of slow news time, I think, until some of these things, some of these bigger headlines come to fruition. And when they do, I'll be right here to report that information to you. I hope you enjoyed just this kind of walk through, this kind of fun look at what's going on around the industry. And I'll see you guys on our next episode of Market Shares. As always, please consider subscribing to the channel so you don't miss one of our episodes that come out every single Friday at 10 a.m. Pacific Standard Time. I'll see you then. Take care.